All right, so we're diving into the world of stock investing today with the 5 rules for successful stock investing, right? This is a Pat Dorsey book. We've gotten some excerpts sent in, and we are ready to break this down.
Yeah, this is going to be a good one. Dorsey's the real deal. He gets right to the point. None of that, fluffy stuff. Just practical advice you can actually use.
That's what I like to hear. He doesn't just tell you what to do, but the why behind it,
Yeah.
Like that whole thing about long-term investing and finding those companies with a real competitive edge. He calls those economic moats, by the way.
Mm-hmm.
And, of course, understanding those financial statements. That's huge.
It is huge. And that's what I really appreciate about Dorsey's approach. It's not about chasing those, get-rich-quick schemes or whatever. It's about building a sustainable approach to investing, something that'll actually last.
Now you're speaking my language. Okay, so Dorsey really hits hard on this idea that, like, short-term trading can actually be bad for your returns.
Oh, he does. And it's so true. Every time you're buying or selling a stock, think about it. Transaction costs, right? Those add up. Not to mention you got taxes on any short-term gains, and those are higher. He tells this great story, actually. It's long-term Lucy versus trader Tim.
Oh, Lucy and Tim, yeah. Classic. I think they both invest the same amount and the same return over 30 years. But here's the difference. Lucy buys and holds just 5 stocks. Tim, on the other hand, churns his portfolio multiple times a year.
Exactly. And the kicker is, even though their returns are the same, Lucy ends up with way more money than Tim, like more than double, just because she stayed in the game, avoided all that unnecessary trading.
See? Patience wins. Sometimes the best thing you can do is nothing. Find those awesome companies. Let that compounding work its magic.
Couldn't agree more. It's time in the market, not timing the market,
Love it. Okay, so we're in it for the long haul. What should we actually be looking for when we're choosing those companies?
This is where those economic moats come in. Dorsey says that if you want those long-term profits, you got to find companies with a real advantage, something that makes it tough for the competition to, steal their thunder.
Like building a fortress around their business. And I know Dorsey breaks down these economic moats into a few different categories. Intangible assets, switching costs, network effects, and cost advantages. Let's break those down a bit.
Okay, so first up, you got your intangible assets. Think about brands, patents, regulatory approvals, those kinds of things.
Right, like Tiffany's, with that iconic blue box. Customers will spend a premium for that.
Exactly. It's not just packaging, it's a status symbol. And then there are patents, right? They can give companies a leg up in their industry.
Although Dorsey does mention that patents aren't foolproof. They expire. Technology changes. Always good to check if a patent's at risk of being challenged.
Good point. And then you've got switching costs. This one's about how much it costs a customer to switch to a different product or service.
Like those medical device companies, right? Dorsey uses the example of companies that make those artificial joints. It's a big deal for surgeons to switch because they have to be trained on each specific device.
It's huge. Think about the time and money involved. Once a hospital's invested all that in a particular system, they're not going to switch easily.
Makes these customers pretty sticky. All right, what about network effects?
So network effects, those are all about how the value of something increases as more people use it.
Like eBay or even Amazon. More buyers equals more sellers, which then brings in more buyers.
It's like a chain reaction that's hard to beat. And finally, we have cost advantages. Pretty straightforward, really. It's about companies that can just produce their goods or services more cheaply.
And Dorsey talks about Intel, right? They make way more microprocessors than AMD, so they can spread out those manufacturing costs, making each chip cheaper to produce.
Exactly. It gives them that pricing power.
So we've found this company. It's got a solid economic moat, good long-term prospects. Now what? How do we look at their financials to make sure they're as good as they seem?
Don't worry. Dorsey's got our back. He spends a big chunk of the book, breaking down financial statements. He wants to make them easy for anyone to understand.
Music to my ears. Lay it on me. What are the essentials?
He's all about the balance sheet, the income statement, and the statement of cash flows.
Okay, but how do we make those make sense? Make them relatable. A lot of people, they hear financial statements and they just tune out.
Dorsey uses a great example. Remember Mike's hot dog stand? He uses that to really break down how those statements work.
I like where this is going. Tell me more.
So the balance sheet, that's like a snapshot in time. It shows what the company owns, those are its assets, and what it owes, its liabilities. It's a way to get a feel for its overall financial health, at that moment.
So in Mike's case, that would be, his hot dog cart, his grill, all those hot dogs and buns he's got ready to go. those would be his assets.
You got it. And any loans he has, those would be his liabilities.
Okay, so that's the snapshot. What about the income statement?
That one is more like a video game scoreboard. Think of it that way. It's showing you how well a company performed over a specific time period, like a quarter or a year. It's tracking revenue and expenses.
So for Mike, that would be the money he makes from selling those hot dogs. That's his revenue.
Right.
Yeah.
You're getting it. And then you'd subtract his expenses, like the cost of the hot dogs and buns, the propane for the grill, stuff like that. Whatever's left over, that's his profit.
Makes sense. And then there's the statement of cash flows. What's that all about?
So this one's a biggie. It tracks the actual cash, flowing in and out of the business.
So we're talking about the money Mike actually has in hand after a day of selling hot dogs, minus, of course, what he paid for supplies and stuff.
You got it. Dorsey really likes this statement because it cuts through some of the accounting jargon and shows you the real deal,
Okay, so our heads aren't spinning yet. We've got our economic moats. We're starting to understand these financial statements. What's next in the world of Pat Dorsey?
Now, this is where it gets really interesting. Dorsey takes us deep into two companies, AMD and Biomet. He shows us how to use all of these principles to make smart investment decisions.
Okay, let's hear it. What about AMD? What makes them stand out?
Well, with AMD, they're in a really interesting spot. I mean, they're one of just two companies that actually make those microprocessors, the brains inside your computer.
Oh, yeah, and your phone. Don't forget those.
Right, exactly. Everything. Your Wi-Fi router. It's a big deal.
Huge industry. And I know for a while there, AMD's chips were actually considered like faster and better than Intel. So they had that tech edge going for them, at least for a bit.
They did. But as Dorsey points out, just because you have a great product doesn't mean the money's going to follow. You need that economic moat to really protect those profits.
Okay, so looking at AMD through that lens, how did they do?
That's where things get a little, let's just say their track record with free cash flow. Not exactly stellar. We're talking inconsistent, bouncing back and forth.
Okay, so not the kind of steady growth we like to see.
Not really. And when you look even closer at their financials, even their operating and net margins, they're better than the free cash flow numbers, but still not great. Out of the past 10 years, they were in the red for 6 of them.
Okay, that's not a great report card.
Yeah.
Not exactly inspiring confidence here. So what else is going on?
Well, their debt-to-equity ratio, not terrible compared to, the market overall. But given that shaky profitability, not ideal. They had this big manufacturing plant they were building.
Okay, vicious.
Very. But it meant a lot of debt, close to $1 billion, actually, on top of their existing loans and all that. That's a lot of pressure for a company that's, not exactly raking it in.
Yeah. Talk about a heavy lift. Okay, what about their leadership? How is the management team doing?
Well, that's another area where, Dorsey says we got to pay attention. And with AMD, it's, a little iffy. Let's just say those executives, they were well compensated even when the company wasn't doing so hot. And there were a lot of stock options being thrown around, which can, they loot things for everyone else.
Right. So not exactly a shareholder-friendly environment you're describing.
Not necessarily. But then there's the issue of valuation. And this is where it gets really tricky with a company like AMD. Their earnings were up and down all over the place, made it pretty much impossible to pin down a reliable price-to-earnings ratio, which is, kind of important for figuring out what a company is actually worth.
Yeah, no kidding.
Yeah.
How do you even begin to make sense of that? It sounds like a recipe for disaster.
It can be. Dorsey talks about developing that, what he calls a bear case, figuring out what could go wrong before you jump in. And with AMD, let's just say there were enough red flags to make you think twice.
Yeah, I'd say so.
Ah.
All right, well, let's move on to our second case study then. Biomet. They make artificial joints, right? What's their deal? Yeah, AMD was a little wild for me. Hopefully this next one is a bit more, stable. So Biomet, artificial joints. That's a pretty niche market, right?
It is. And that's one of the things Dorsey really wants us to see here. They're in a totally different ballgame than AMD. I mean, think about it. You don't see a new hip manufacturer every day, There's a lot involved.
Makes sense. You got your specialized knowledge, the manufacturing processes, and then there's a whole medical device approval process, right? I bet that's no walk in the park.
Oh, for sure. It's a very research-heavy industry, and each company, they have their own designs, materials. So surgeons, they need specific training for each one.
So there are those switching costs we were talking about before.
Exactly. Once a surgeon's used to a system, they're not going to switch unless it's, really worth it.
Biomet's got that moat. But what about their financials? Are the numbers as good as their position in the market?
Oh yeah, night and day compared to AMD. We're talking consistent free cash flow, growing steadily, their margins strong, and their balance sheet nice and clean. No long-term debt to speak of.
Okay, now you're just making me greedy. Give me the details. What were those standout numbers?
Well, their gross margins. Consistently over 70%. That tells you they've got pricing power. They don't need to, slash prices to compete. And their overhead, steady as a rock. That says good things about how they run their business.
Efficient and profitable. I like it. But what about leadership? How is the management team? Any red flags there?
Dorsey always says, check out that executive compensation. And with Biomat, everything seemed reasonable, especially compared to, our friends at AMD. The CEO's compensation, pretty modest, no crazy perks or anything like that. They were using those stock options strategically, not just throwing them around.
That's refreshing. It really is all about finding that right balance, isn't it? Okay, so we've got a company with a strong market, the financials are there, and management seems to know what they're doing. It almost sounds too good to be true. What's the catch?
You're right to be cautious. Dorsey, he's big on this. Always have that bear case, those what ifs, even for the companies that look like, sure things.
All right, so what could go wrong with Biomet? Give me the worst case scenario.
Well, one thing that comes up is litigation. Medical device companies, they can get hit with lawsuits. It comes with the territory.
Yeah, that's true for a lot of industries, though. Anything specific to Biomet?
They did have that one charge, something like $55 million for a legal settlement. It's definitely something to watch. Another thing was their international performance. They make a good chunk of their money overseas, but those operations weren't as profitable. That would definitely need more digging.
Interesting. Are there cost challenges overseas? Maybe pricing pressure? Lots to think about there. Anything else?
Well, they were smaller than some of their competitors. That can be tough in this market. Those bigger companies, they often have, an easier time getting better deals and all that.
Economies of scale. Hard to beat that.
For sure. And one last thing. Biomet, they've been really good at keeping those prices high. But healthcare, right? It's always under the microscope. New regulations, changes to insurance, you never know.
It's a reminder that no investment is completely bulletproof, right? You've got to do your homework. That's something Dorsey really drives home throughout the book.
Absolutely. And part of that homework is figuring out what the company's actually worth. How do you put a price on that future potential? It's tricky. Like with Biomet, they'd been doing well, so people were willing to pay a premium for their stock. But that price to earnings ratio, it was a bit of a mixed bag, higher than the market, but lower than their own history. Tough to know for sure.
It's never as simple as it seems, is it?
Nope. And this is where Dorsey goes deeper into things like discounted cash flow analysis. That's where you're trying to predict those future cash flows and figure out, what the company's truly worth. But even then, you're making assumptions. Are you being too optimistic? Not optimistic enough. You got to factor all that in.
It's like you said in the beginning, it's not about some magic formula. It's about thinking critically, understanding the whole picture.
Exactly. And that's what makes it so interesting, right?
Totally. This has been an awesome deep dive. So much good stuff in Dorsey's book. If you had to pick, what's the one thing you really want our listener to remember?
I think it's that successful investing, it's not about, luck or timing the market perfectly. It's about putting in the work, understanding how these companies work, and making smart decisions based on the information you have. And of course, remembering that everyone makes mistakes. It's about learning from them and becoming a better investor.
Couldn't have said it better myself. This deep dive has given you the tools. Now go forth and conquer those markets.